Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Tellurian, specifically about their pricing risk with their upstream sourcing gas, and at what point could they actually end up breaking even and then maybe even losing money. So I'm going to go over that in a minute. Before I begin, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Tellurian. So basically this video should be for entertainment purposes only, because I could be wrong about everything I say in this video. You need to do your own research before making any investment decisions. So this is in response to a comment that I got. And I thought it was a good question. It was a great question because of two things. Number one, I think everyone should understand what is the downside for what they're investing in. I think this is a major risk that could potentially lead to downside. And number two, like I actually don't hear this talked about too much anywhere else, right? And it's something that you really should worry about given where Henry Hub prices are today. So the question from KY Doctors for Life is, what would the results be if they had to rely on feed gas from elsewhere for the vast majority of natural gas, and if Henry Hub remained around $8 while JKM and TTF were around $12? And so I had a short response there, but I wanted to explore this a little bit more. Because if you recall, right, and I went over this in a prior video, so I'm not going to go into this too much, but like Tellurian, their contracts, the amount of revenue that they're going to get is structured based off of the gas the spot prices, right? The JKM or the TTF. This is in contrast with many other sales and purchase agreements that have been signed, which are effectively Henry Hub plus some amount. That is to say, Henry Hub, the sourcing gas, the gas that they have to purchase, plus some amount for liquefaction, and their costs, whatever, of the actual LNG exporter, right? And I think those are the form of the contracts that most other companies have signed, right? That's clearly a much lower risk, right? You don't need to wonder, hey, what happens if Henry Hub prices stay high and JKM prices fall and are low? Because you just hey, look, they're actually looking at Henry Hub and then adding on their fee, right? And so their fee is their fee, regardless of kind of what the commodities do in terms of pricing. But Tellurian, that is not the structure of their contracts. They are exposed to this commodity risk, right? And so generally speaking, you can see in the model here, right? This is the model, and I have my own model that goes in a little more detail to the best of my ability. But this is the model from Tellurian's most recent investor presentation, and it's very simple, right? They have the LNG sales price in dollars per MMBTU, and this is after you subtract off shipping. So they have this at $12. They have their gas sourcing, and again, this is from November of 2021, so this is a credible number at that point, of $4 per MMBTU. They said, hey, it costs us about $1 to liquefy and transport, to do all of our stuff. And then they say, hey, great, we have a $7 margin per MMBTU multiplied by, their annual 550 billion cubic feet. And then you're looking at $4 billion in, sort of gross profits is where I would categorize that. And so obviously there's a ton of variables in all of that, and it doesn't account for some other things. So I built my own model, and I have used it a bit in other videos, but I simplified it down here just to look at and I pulled out all the parameters so that we can see what is the impact of all these things. And I want to talk about a couple different points from this. This column here, let me make this a little bit bigger. Sorry, that's probably too small for you to see. Right, so this column B here, column B, C, and D are just sort of the same calculations, but in three different scenarios, right? Column B is if they have to purchase all of their gas upstream at Henry Hub price. Column D, skipping over C real quick, is if they, sorry, I got that backwards. Column D is if they have to purchase all of their gas upstream. Column B is if they produce it all themselves. And column C is if they produce 1/3 of it themselves. And you can watch my prior video talking in my prior video. I sort of gave my rationale as to why I think it's reasonable to expect them to produce around 1/3 of what they'll need for Driftwood LNG phase 1 without having to acquire anyone else or any additional assets. I think they've talked about acquiring other assets to do the full full production themselves of the gas. But I mean, I think we would expect further dilution, right? Further issuance of equity to fund that, or some sort of merger. I have no idea what format that would take, but I think that's something that is nice to look at, but is kind of hard to really reason about, in terms of, like, we can look at the profitability, but what we can't reason about is what is the profit per share, because who knows how many shares that would be divided amongst, because there's a whole lot of variables there. But today I included just so that we can sort of see the differences in profitability in terms of gross profits for the company, right? Or gross, and even sort of overall net income, just not net income per share, and in sort of this rough model. And the calculation I have is very similar to what they had. I include their actual LNG sales minus the shipping already. And I have an actual calculation over here for some of that. And then how much it costs them to get the gas, right? And this is if they're upstream. We just sort of assume that's one fixed amount. If this is buying off the market, that comes from whatever the market cost would be, and I have a variable for that over here. We'll start playing with things in a minute. Then you have the actual liquefaction costs. I kept this the same as what they had, $1 per MMBTU, because I sort of believe them that that's what their costs can be, and then multiply by that gets you their margin, right? That's this row here, margin per MMBTU, multiply by the capacity. That gets you their gross profit in billions of dollars, right? That I would sort of call out their gross profit. And then I think you also have to subtract off, right? What they were looking at, just the Driftwood project itself. But I think for Tellurian, we also have to subtract off some estimate of what their operating expenses and their SG&A are going to be. And then we also need to subtract off what they're going to pay for their interest payments, right? And that should give us an idea of what the final sort of net income would be after all of those expenses. And so here I have reproduced roughly what their model was, right? $12 for selling the LNG after shipping costs, and then the gas sourcing costs vary depending on the specific scenario you're talking about. Multiply that out, and then you get these numbers here. Now, I want to talk about some of these pieces, right? And I put some parameters over here that we can just talk about. The LNG price, right, in their model, it's very simple. It's one number, JKM less transportation. But this is actually, there's a lot of the different things that go into that. Not the least of which is the fact, if going back to what is the structure of their contracts are not trivial, right? It's not just everything is strictly off of JKM. As I talked about last time, and I'm not going to go in detail here, but some of this is based on JKM, some is based on TTF. For the purposes of the discussion today, I assumed that for these two contracts that say there's some percent of JKM and some percent of TTF, I assumed that they were 50-50, and then this SPA with Shell is only JKM. And so based on all of that, that gets me to numbers where I say, hey, there's about 6 million tons per year priced at JKM, 3 per year priced at TTF in the current scheme. And then that also leaves the additional 2, right? If you look at the visually, right? Driftwood LNG phase 1 is 11. They have 9 locked up, 6 to JKM and 3 to TTF, I assume. And then 2 that is theirs. So they can do with it as they please. And for this model here, I actually split out JKM and TTF, and right here I just put numbers that made it come out to that magical $12 number that matched what they have. But I think it is important for us to understand that last 2, right? Of course, they're going to sell it wherever it makes the most money, right? So if JKM is high at one point, they'll sell it there. If TTF is high at one point, they're going to sell it there. And again, it's after shipping costs. And the interesting thing is that the shipping costs actually differ, right? It's cheaper to ship to Europe because it costs, because it takes less time to get to Europe. So plain and simple, it just costs less to ship it there. And in fact, I was doing a little bit of research on the shipping costs, and apparently the shipping cost for LNG went almost to zero for a point in time, just because there was a certain amount of capacity that had been based on shipping a lot of LNG to Asia. And then all of a sudden, prices were way higher in Europe, so the LNG now gets shipped to Europe, and that was a shorter, much shorter trip. And so there was actually the rates went down because there was so much more availability of the tankers they actually ship the LNG. So I thought that was interesting. But if we look at this and we say, hey, to answer the question, so I'm going to go back. This is my 10-minute way to answer your question, but now we can have a more reasoned discussion about it. If TTF and JKM were around $12, so let's put in $12 for JKM, $12 for TTF. Then if we say Henry Hub prices was actually $8 per MMBTU. And again, this is using the numbers that were sort of in the question there. And so to answer this, I'm assuming that then the shipping costs would be subtracted off of that $12, right? When we say TTF and JKM are those amounts, then that's what I'm looking at here. And so if we had these numbers plugged in here, what happens is now your actual, the amount that you're getting after shipping costs, which again, I think those shipping costs are really reflected by this amount that gets subtracted off from these in the contracts, but who really knows? But just for the sake of this model, that gets us about $10.45 per MMBTU for LNG, and then it comes down to how much are you actually paying, right? So if they produce their own gas, and they, as they've sort of put in their investor presentation, they think that they can do that for about $2 per MMBTU. They can still be profitable if they are producing their own gas. If they are purchasing at the market, they would now be losing money, right? And I actually color coded this down here. They still have a little bit of margin even at that point, right? Because they're still making some gross profits, but sort of in my model here, after they pay for their operating expenses, after they pay for their interest payments, now they're losing money. And by the way, my assumption for interest right now is that they take on $9.1 billion of debt. That's if they go the 70% debt route. That's roughly the number that I came up with. And then that's at 12% interest rate, right? And then I think, like I said, I have this $200 million per year of operating expenses and SG&A. And I pulled that number from sort of an early, I think a Cheniere filing, a 10Q or 10K from, 2017 or 2018, when sort of I judged that they were in roughly the same phase that Tellurian would be when they start operating Driftwood LNG phase 1. So that's where that number came from. Again, feel free, as always, in the comments, if you think I got something totally wrong, please let me know. I'm not a professional here, not an expert, but that's how I'm doing my best as an individual investor to try to model this out and get my own feel for things. So if you look at this, right, there's a couple things that are interesting, right? Number one is, they're profitable if they are able to produce it. They're not profitable if they were buying at the market, even though they do have, a positive gross profit at that point. But the interesting thing is that even if they are 1/3 hedged, they still can eke out a little bit of profit, right? So that hedge actually makes a big difference in terms of in scenarios where Henry Hub prices go up, or are high, I should say, as they kind of are now. Is there an actual reason for TEL to not get financing eventually, or for other companies like Next to get financing before TEL? So, sorry, I got a question on the chat. That was the question. It was, let me repeat it a little better in the microphone. Sorry, I'm still new. This still doing better. Is there an actual reason for TEL to not get financing eventually, or for other companies like Next to get financing before TEL? So, I'm going to address sort of the second part of that. I think it all comes down for the banks. This is, again, not an expert, my opinion, and from what I know, really the banks are looking at it from a risk perspective, right? They are lending them the money, and they want to make sure they're going to get paid back. And so I think for a company like Next, I believe that the vast majority of their contracts are just linked straight to Henry Hub prices, right? Henry Hub plus a certain amount. And I think that is a lot lower risk for the banks, because they can just look at it and say, how much is Next going to get in terms of profit? That is, because Next's gross profit is the bank's potential to get paid back, right? The banks are going to take it straight off of that. And so when they see that next decade, right, they do not have the same commodity risk that we're talking about here for Tellurian, where if we say, hey, because if you look at this, right, in my model here, LNG prices of JKM and then, TTF in Europe, they can do whatever they want, right? They can go to $5 and Next won't care, right? And Henry Hub can be $8, right? Henry Hub can be higher than the LNG prices in Asia and Europe. But since they're just getting, sort of profit on top of whatever a Henry Hub is, or a fee on top of Henry Hub, it doesn't matter to them. Therefore, I think from the bank's perspective, that's easier to finance, right? That's the way that I see it, because it's just lower risk, right? Next does not have all the risk that Tellurian does, and that's sort of the blessing and the curse of Tellurian is when you look at the current macro environment, and if you sort of have an opinion on how the macro environment is going to be going forward, right? In terms of what does that spread look like? What is the demand for LNG versus how easy is it to, or what is it going to be the demand and supply for gas here in the United States? With Tellurian, as long as we have this, we can have this huge spread and Tellurian gets a profit off of all of that. But again, it cuts both ways, where if that spread disappears or even turns negative, Tellurian will be losing money. And that's what I'm sort of trying to show here, is in what situations do they actually lose money or break even. I mean, to your first question, again, that's the $1 million question, or the $1 billion question is there a reason for Tellurian not to get financing eventually? I don't know. Like I will give you my opinion is I am invested in Tellurian. I have a non-trivial amount of my money in Tellurian, and I do think that they're going to get financed, right? I think the macro picture is there, and it's super clear. That's I have a video somewhere about Tellurian, about sort of, let's look at what the forward spread looks like over 5 and even, I think even over up to 10 years of what we had for some of the at least TTF and Henry Hub pricing, where we can see that like the futures out for 2030, there's still a huge spread. So in my opinion, I think I think they're going to get the money, because I think that spread exists, and I think it's going to continue to exist from what I understand about the macro picture. I hope that answers your question. I know that doesn't really answer your question in terms of is there a reason for Tellurian not to get financing, because I don't know. Like, if I knew that 100% that they were going to get financing, or I knew 100% that they were not going to get financing, I'd make a very, very sizable bet in, even more than what I'm currently invested, sort of one way or the other. But, again, I am long Tellurian. I do think that they're going to get the financing, because I just think that the macro picture is there. The macro picture is there, and I think if you're talking about the risks of the actual company, if I'm put on my hat and say I'm a bank and I look at Tellurian as a company, right? Another one with these, early startup companies, that's really what Tellurian is sort of execution risk. And I think that's where you look at Tellurian, and that's, the piece that really shines through is you say, I really don't think there's a lot of execution risk with them because they've done it before. Yeah. So anyways, thank you for the question. Let me know if you have some follow-on thoughts or comments or questions. I'd be happy to. Cool. He or she says it does. Thank you. So I'm going to continue on with some of the implications of this model here that I have, and what this means for when would Tellurian make money, when wouldn't they, right? One of the other big factors here is, how much debt do they actually take on? Because if you look at a situation like this and you say, well, if they actually went with the lower debt amount, the 60%, I sort of put the numbers here in the margin so I could get that. That's, $7.8 billion in debt. And that doesn't actually change the profitability, sort of which scenarios are profitable, which aren't, but it does actually change it a bit in terms of, well, when they pay less in interest, right, they're actually making more, they have more free cash flow. And hopefully that's like obvious, but I mean, on the flip side, that means that they would have to dilute more, right? But I think this is sort of a risk and reward type thing. Again, it's another axis here, but sort of the less debt that they take on and the more equity that they dilute, when things are in sort of a bad situation, right, you're paying less in interest, therefore you sort of have lower, your downside is protected more. Granted, if you actually believe in the macro picture and you think that there is going to be this spread, you do want them to take on more debt because it's less shares to distribute the profits against, right? Because when there were profits, you want it to be split across less shares. But I was just calling it out that like it's not all bad if they end up diluting more and having less debt, because that's lower payments that they're going to have in debt, and sort of lowers the downside if there does happen to be some point in the future where they where the spreads just are pretty thin. So yeah, again, I think it could be a whole nother video just talking about sort of the Henry Hub, what's going to drive Henry Hub prices and what does that macro picture looks like. And I mean, I did at least went through the futures in a prior video, and I think even going out years, like the futures prices are going down. They're in like the $4 range, I think, if you look out a couple years, whereas the TTF prices stay elevated. Even the JKM prices were still pretty high. So there's still quite a bit here. Another one here is the shipping costs. Right now, that is interesting to look at, where it is cheaper to ship to Europe. And so, especially those 2 million tons per year that Tellurian has that they can ship to wherever, like, if gas prices are sort of kind of compressing, getting lower and lower, LNG prices, it is JKM and TTF, like that might actually be a factor where they might ship more to Europe just because it's it's cheaper for them to ship it there. Yeah, I think that mostly covers it. So hopefully I answered your question. But I guess let me also throw in some other numbers, right? Like, how much does it take for them to now make it so that even buying off the market, it's profitable, right? If we look at JKM and TTF for 12, but if Henry Hub fell down even to, even higher than it has been historically, but just to $6 per MMBTU, right now all of a sudden they're profitable, right? And that's true even if they take on more debt, I think. Yeah, so they're still profitable even in that situation. I think historically this is roughly like average numbers. Again, it goes all over the place. And I actually pulled up the charts. If you wanted to look at this, you could see TTF historically. Actually, I was wrong. This was pretty low as long as these numbers. I just got this from Y charts. Hopefully this is the right thing. This is European Union natural gas import price. I think that's what this represents. It's kind of hard to tell. It's kind of hard to get good charts for this. I don't know. Maybe there's a good source for it. But historically, I guess this one was pretty low. We're looking at 9. Wow, that got real low. I mean, during COVID, but so did everything else. And you can see it's ballooned up recently. JKM, historically was around 10, 12. But again, it's really hard to actually look at these numbers credibly and think that there's not going to be a spread, because if you look at Henry Hub historically, you're seeing prices in 2, 3, 4. So even back here with JKM, the spread was there. So, which again is sort of the thesis behind Tellurian and the impetus for them starting this company and their belief. So, all right, that is it. Any other thoughts or questions, Ladder? So I don't know if I repeated your name earlier. That was a great question from Ladder, so thank you very much. If not, just for anyone else who is watching after the fact, I do these videos usually live around 10 or 11 p.m. Eastern U.S. time. I'd be happy to have folks on live like we had today. Thank you for chiming in. And looks like there's nothing else on the chat, so I am going to hop off. Thank you very much for watching today, both Ladder and anyone else who is watching this after the fact. Have a good one. Oh, I see a yes. Was that a yes? You have another question? I was just about to hop off. Time out now. Cool. All right. I'll hang out for a minute. Let me see while you're typing. Did I have anything else to say about this? Check my notes. I actually took notes, but I didn't actually look at them. Oh, just one other quick note while you're typing. The other thing to consider is that there are actually minimums in these contracts, right? So there's a minimum price when they are calculating JKM. There's a minimum price when they calculate TTF, and this is written into all of the contracts. So it is interesting that like if in some future situation, let's say, where hypothetically, let's say there was a brand new renewable source of energy with solar panels that are effectively so cheap, everybody has solar panels everywhere, and all of a sudden gas prices, JKM and TTF and Henry Hub all go super low. The interesting thing is that they do have this minimum. I'll get to your question in just a second, because this is the one last thing I did have written down to talk about here. If let's put in the hypotheticals that let's say Henry Hub fell down to, $1, right? Prices go way low for energy. And let's say if JKM and TTF both went pretty low, but there's actually these minimums in the contract. And we don't know what they are, but let's say those minimums were like $5 for these. Maybe 5 is too low. Sorry, I was trying to make the point that as long as there's some minimum in there, they can actually still potentially make money even if the spread exists. We just don't know what those numbers are. So I just wanted to call that out. All right. Question from Ladder. This question is more related to your last video, but how does starting construction now without financing play into their ability to drill wells? I would also assume the more progress they make, the easier it would be to get financing right. So I don't know that them starting construction now really has anything to do with them drilling the wells, right? Because it's Bechtel that is starting construction on the actual terminal, right? It's a separate company, it's their contractor. Whereas I think, as far as I understood, it's actually Tellurian who is their staff that's drilling the wells. I could be wrong on that. I'll be honest to say that I haven't done tons and tons of I haven't done a lot of deep research to try to understand that part, because it's only something that they kind of have already been doing. But I think Tellurian staff actually drills and operates the well, or local contractors, right? It's something that they're doing that's sort of a bit separate from the actual construction of the LNG liquefaction facility. In terms of, is it easier for them to get financing if they make more progress? It made more progress building the facility. That I don't know. I mean, from an investor's perspective, it certainly makes it a higher risk, higher reward proposition, because sort of the timeline of when they're going to start shipping LNG is now pretty much fixed, assuming that they get financing. From the bank's perspective, I don't know that it changes anything. I mean, I guess the piece that would change is as they sort of are issuing equity and diluting, as we've seen with their at the money program. If the more equity that they issue and the more that they've paid for this, the less money that they really need from the banks. So from that perspective, it could potentially make it easier to finance if they just are asking for less money from the banks. And potentially if it's later in time, right? So bear with me, hypothetical, and I know this doesn't really work out with the timeline of their sales agreements, right? Because those have actually those have an expiration date. But let's say for whatever reason they haven't gotten financing 6 months from now, but they've continued paying for construction 6 months from now, just through diluting, selling stock. And at that point, the banks, they sort of have like a 6 month shorter time period during which they have to actually project things out in order to start seeing real money come back in. So I don't know, maybe that helps, but I'm actually not sure that it helps them too much getting the financing. I think it's neutral. It certainly makes it higher risk for us as investors in the stock, because or in the common equity there, because they're burning a lot more cash, obviously, and issuing a lot more shares. But I don't think it actually makes it easier for them to get financing. I think it's kind of neutral. That's sort of my perspective. Yeah. Anyways, thank you for the question. Again, I'm not an expert in this stuff. I wish I was. I'm just an individual investor, but that's my thoughts. So, all right, I really have to hop off now. Thank you very much for tuning in, and thank you everyone else for watching. Have a good one.